Hi everyone, welcome to this next video. In this video I'm going to be discussing a few definitions. Caleb's quite happy to be hearing these new definitions. There you can see a little bit of rain in the background. In this video I'm going to briefly discuss financial statements. I'm going to look at some more definitions. Then I'm going to compare the formal sector versus the informal sector. I'm going to look at characteristics of both sectors. I hope you enjoy this video and you learn and gain more knowledge. So let's roll the dice, and we've rolled a 4, and let's get going. A trial balance is a summary of all the general ledger accounts at the end of each month. You can see here this trial balance was drawn up on the 31st of January 2023. There's a section for a statement of financial position section, which means you've got your owner's accounts, capital and drawings, assets and liabilities. So that is the accounting equation. Assets equals owner's equity plus liabilities. But in this balance sheet section or statement of financial position section, you've got your owner's accounts, assets and liabilities. All these accounts will have a folio reference. In this case here we have B1, B2, B3. That actually stands for balance sheet account number 1, balance sheet account number 2. But we know the name of a balance sheet has changed and it's now called a statement of financial position. You could actually have the folio reference of your choice, but most textbooks still use B1, B2, B3, balance sheet account number 1, 2, 3. Then there's a nominal account section for income and expense accounts, and they're also given a folio reference. In this case here, N1, N2, N3, N4, nominal account 1, 2, 3, 4. Normally the income accounts come before the expense accounts. Then there's a column for those accounts that had debit balances, for example, drawings, trading inventory. Then there's a column for those accounts which had credit balances, capital, accounts payable, sales. These accounts here end up with debit and credit balances according to the accounting rules. For example, trading inventory, which is an asset, should normally have a debit balance, meaning that we've got an asset stock on hand. So this is a trial balance. What is interesting about a trial balance, right, it is drawn up at the end of every month, and what happens is these balances will increase or decrease over the financial year, over the 12 months, the period that we are recording the transactions for. It's called our financial year. And after every month, these numbers here will change, and after each month you can calculate your profit or loss to date by saying income less expenses. Just a little bit of extra information there in this nominal accounts section. So if I took, for example, these are the numbers or the figures for January, and I said income less expenses, I could determine what my profit or loss is at the end of January. A trial balance is also a checking mechanism to see if my debits equal my credits, because both these columns, the debit and the credit column, they should equal. If they don't equal, we may have made an error in recording the transactions for the month of January, and we need to go and check where we made the error. If these two numbers here, the totals in the debit and the credit column, equal, it doesn't necessarily mean that this trial balance is accurate. Errors could have been made. We could have left out a transaction completely. The wrong account could have been debited. For example, we could have debited salaries and wages instead of stationery. The debit and the credit column will still equal, but the balances of individual accounts could still be incorrect. So trial balance, if the trial balance balances, it doesn't mean that this trial balance is completely accurate, but if it does balance, there's a good chance you have done your books correctly. So in summary, a trial balance is a summary of all the accounts of the business after they have been totaled and balanced in the general ledger. The trial balance will check that your debits equal your credits. This is my office. It's the office of Calibu Education, and hopefully I'm going to be generating a profit from this space. That brings me to the next document, and our next document I'm going to look at is known as a statement of profit or loss and other comprehensive income. That's the name of the statement. It used to be called the income statement, but this is the new name given to an income statement. And in the income statement, we're going to have all our income accounts and all our expense accounts summarized in a formal way to show the financial results of your business over a period of time. So if we look at this example here, that of Calibu Education for the year ended the 31st of December 2023, we have our income, sales, less the cost of sales, and that's going to give our gross profit. So the first part of this statement, we are showing the gross profit. How is the gross profit calculated? Revenue, sales less cost of sales. And if there were any sales returns, that would be taken off sales. If there was any spare cash in the business, it would be wise to invest that money into something like a fixed deposit where we can earn interest. So we got income from sales, and if we add other income, for example, interest income, Now, this interest or any interest, according to GAAP, generally accepted accounting practice, should be shown separately. So the details of this interest would be shown in a note to this statement. How that 50,000 was derived. It could be, for example, you have a fixed deposit of 500,000, earning 10% interest per annum at a simple rate, and that would give us 50,000. So we got income plus other income, and that is going to give us total income, the gross income. In this example here in front of you, that is 250,000. So it was the gross profit plus other income gives total income, gross income, 250,000. Then what we need to do, or what we need to show in this document, are all the other expenses, the operating expenses of the business. Say, for example, stationery, advertising. Now, if we take off those expenses of 16,000, we will get the profit or loss before finance costs. Now, what are finance costs? An example of this would be, for example, if I took out a loan to start Calibu Education, the bank with whom I took the loan out would charge me interest. Now remember, I mentioned earlier, interest is shown separately in a note to the statement of profit or loss and other comprehensive income. All interest is shown separately, either interest income or an interest expense. So the details of how this 34,000 Rand was reached would be shown in the note to this statement. So there we go. The interest expense was probably an interest on a loan or interest on a mortgage bond in order to purchase Calibu Education. It might have been financed, that office. And the cost of financing this building through a loan is the interest expense. So in this case here, these figures are made up. Calibu Education has made a profit for its first year of trading of 200,000. So in this document we have all the income and all the expenses, and that's either going to give us a profit or a loss. If the expenses were greater than the income, there would be a loss. Hopefully the income is greater than the expenses, and in this case it was. And the profit for the year of Calibu Education, the financial result, which indicates the profit or the loss for this little business, is 200,000. So in this document, the profit or loss is presented formally by subtracting all your expenses from your income. This is known as the financial result for the year. After making a 200,000 profit, the owner decided to take the family on a holiday, because who's entitled to the profit? The owner of the sole proprietor. So next I'm going to look at the statement of financial position. And if I have a look here, the statement of the financial position of Calibu Education, The financial position of a business is calculated on the last day of the financial year. So at a point in time, the business or the owner, seeing that this is a sole proprietorship, is worth his assets less his liabilities. But what we got here, in this formal way of presenting the financial position, it's written assets is equal to owner's equity plus liabilities. So all these accounts, statement of financial position accounts, remember this document, statement of financial position, was known as a balance sheet. So all your balance sheet accounts are going to be presented on this document. So we have assets, owner's accounts, owner's equity, and liabilities. Now some of these accounts are summarized in notes. For example, property, plant, and equipment. That note will summarize your non-current assets, but your non-current assets will be shown in a note. Stock will be shown in a note. Trade and other receivables will be shown in a note. Same as non-current liabilities and trade and other payables. Now the profit from the financial result of the business, in this case here, in the previous slide it was 200,000, it would be shown in owner's equity in a note. I've covered up here with this sign, but note number 6, we will be looking at owner's equity. So what we got here is the accounting equation shown on a document. Let me rub this out because it's getting a little bit too busy and it's not as clear as what it should be. But on this document you have assets, owner's equity, and liabilities. Assets equals owner's equity plus liabilities. So our non-current assets consisting of non-current assets, property, plant, and equipment, and financial assets comes to 350,000. We have current assets consisting of inventory, trade and other receivables, cash and cash equivalents, it's 120,000. So the assets, when we total non-current assets and current assets, in this particular example, is 470,000. Now that is equal to owner's equity of 200,000, which in this case here is only the profit made from the financial year. Owner's equity can include capital, drawings, and the profit or loss. Non-current liabilities, it's your long-term liabilities. For example, a mortgage loan, plus your current liabilities, and yeah, they actually list the current liabilities on the face of this document. Trade and other payables, 60,000. Bank overdraft, 40,000. So their current liabilities of 100,000. Now if you add the owner's equity plus non-current liabilities plus current liabilities, it will give you 470,000. Now this document here is a picture of your financial position at the end of the year. Now, if we do a little bit of analysis and interpretation, which we will do at a later stage, we can make a whole lot of sense from this document. There are a whole lot of ratios that we can calculate using the numbers on this document, but more about that a little bit later. The statement of financial position, what is on this statement, what is on this balance sheet, are your assets summarized, owner's equity, and liabilities. And if you did want to calculate what the owner is worth, you could play around with these numbers here, but the owner is equal to his assets, the total value of his assets, less the total amount of money owed liabilities. It's very interesting, but they change the way this is laid out. And they start with assets, then they do equity and liabilities. Let's play around with what we've just touched on. In the previous slide, I mentioned owner's equity, liabilities, assets. So let's just take a closer look at owner's equity. What is owner's equity? Owner's equity is what the owner is worth. And the owner's worth, the owner of the sole proprietor, it can be determined what the owner is worth within the business. And the owner is worth the value of the assets, I'm looking at a sole proprietor, less the value of the liabilities. So what the sole proprietor owns within the business, less what the sole trader owes within the business. So that is owner's equity. There are four things, four categories, four items that have an effect on owner's equity, and they are what the owner puts in, capital. The owner can invest money into his or her own business, or an asset, for example, a vehicle, can donate a vehicle to the business. Then there's drawings, what the owner withdraws from the business. Once again, it can be stock or cash. Doesn't just have to be cash. The owner can withdraw items from the business. Could even be stationery. Then a sole proprietor makes money by the nature of his or her businesses. Calibu Education would sell digital products to derive an income. And in order to run the business, there would be expenses. Now these four items, I've made an acronym, DICE. They affect owner's equity. Drawings, income, capital, and expenses. And we've just learnt in a previous slide, income less expenses is either a profit or a loss. So the owner's worth can go up or down depending whether the business made a profit or a loss. So what would increase owner's equity is capital. What would decrease owner's equity would be an expense or drawings, and income would increase owner's equity. And there we go. The owner is worth his assets, the value of his assets less the value of the amount of money owed. within the business. And if you make assets the subject of the formula, you will get assets is equal to owner's equity plus liabilities. A O L. Assets is equal to owner's equity plus liabilities. And that is the format of a statement of financial position, which we have just looked at. And that is the accounting equation. Assets equals owner's equity plus liabilities. So there I was just playing around a little bit with owner's equity and the accounting equation, but assets is equal to owner's equity plus liabilities. Every single transaction within the business has an effect on the owner's equity, and after every single transaction, the left hand side will equal the right hand side. Every business needs assets in order to operate. Assets are purchased by the business in order to help achieve making a profit. So we get non-current assets and current assets. Remember, in accounting, when we talk about non-current, we're looking at a period greater than 12 months, whereas current, we're looking at the current 12 months that make up our financial year. So non-current would be a long-term asset, and let's say a current asset would be a short-term asset. So there's a little bit of theory here. Most of the time, an asset is purchased by the business for use within the enterprise, within the business. An asset obviously has monetary value and is owned by the business or partly owned. Cash is the most liquid form of an asset. When we talk about liquidity, the more liquid an asset is, the closer it is to cash, and if it's completely liquid, it will be cash. So say for example, a vehicle is not liquid as it isn't close to cash, but as we get a little bit to more other assets, for example, the school is a debtor of Calibre Education. Now the chances of us receiving money from the debtor will depend on the terms. So the school, in theory, is closer to cash than a vehicle. So debtors are more liquid than business vehicles. Then obviously if we went to cash, we might keep cash on hand, for example petty cash to buy small items. Cash is the most liquid form of an asset, and cash would be a current asset as it is cash. A debtor like the school would be a current asset because they are going to pay us within the agreed time period. So it could be a month or 2 months or 3 months, but it's not greater than 12 months. So accounts receivable is a current asset. But a vehicle, let's say for example a delivery vehicle, is not purchased for a period less than 12 months. It's most probably purchased for a period of 4 years or more. So a vehicle would be a long-term asset or a non-current asset. And there's some written definition of a non-current asset. So we bought the asset for a period of time greater than 12 months. There's no intention of immediately reselling this asset, and the asset will be used in order for the business to generate a profit. For example, land and buildings, equipment, furniture and vehicles. They are long-term assets, non-current assets. Now, a current asset is either cash or an item that will be converted into cash. For example, a debtor within 12 months. Examples of current assets: a positive bank balance, petty cash, debtors or accounts receivable, trading inventory, stock on hand. So there we go. All businesses need assets in order to operate. Most businesses need to borrow money in order to operate, and this results in a liability. So you can go to a bank and finance your business. So that will result in you taking out a loan as part of your capital in order to start your business. And therefore you'll have a non-current liability, which is a long-term loan, as an example. And then you might also need to open up an account. Here we have the computer store. So Calibu Education has an account with a supplier, the computer store, which means they can buy items, get the items now, and pay for those items over an agreed upon period. So we've got credit. We've got credit from the bank, lend money now, pay back later. We've got credit from a supplier, get the goods that we need to sell now, pay them back over time. But this results in us having liabilities, and they could be non-current, which is a long-term liability. We are liable to pay back the bank over 5 years, for example. It's a long-term liability. But our supplier, the computer store, we need to pay back within 3 months, accounts payable. So a liability comes about when we borrow money or buy something on credit. The above two types of transactions result in the business owing money to either a financial institution like the bank or a supplier. We are obliged, we are liable to pay back the loan, and we are liable to our creditors to pay them what we owe them. Here is an example of a non-current liability. A mortgage loan is a loan that is taken out with a financial institution to buy property. Then you got current liabilities. For example, I did mention a creditor, a short-term obligation to pay back money. You might even have a bank overdraft where your current account has gone into overdraft. So your bank has moved from an asset to a liability. We had cash in bank, spent too much, went into overdraft, and it's moved therefore from a current asset to a current liability. If we go into overdraft, that means the bank has given us the facility to spend more than what we have in our bank account. But remember, when you go into overdraft, it will cost you because the bank will charge interest. So there we go. Liabilities can be both non-current and current, and I've discussed a couple of examples. So we've lent some money, and now we need to start paying those loans back. And why did we lend the money? In order to earn income, to buy stock, to set up our shop, so we can sell our products or render a service. But now we need to start earning income to pay the amounts, the liabilities that we have. So income is the term given for how the business brings in money. Money can be earned in several ways: through the sale of stock, rendering a service, or we could have invested money and we earn interest on that investment, commission. So any which way money comes into a business, that is how we derive income. Here's an example of what we do at Calibre Education. We sell digital products like the product, the video you are just watching at the moment. They're examples of the digital products, so that's a way to derive income. Some people render services, for example, a hairdresser. There's Caleb having one of his first haircuts. And if we have spare cash, we can invest that spare cash in a financial institution, and we will earn interest or capital gains on what we've purchased. But we can earn income through investing the money we have spare in the business. So there are three ways of earning income. It is expensive to operate a business. Any business will have expenses. So an expense is the term given to the costs of running the business. So every day you're spending money so your business keeps going. Examples: stationery, advertising, salaries, fuel, the telephone, and wages. These are all examples of expenses. An expense is an item that is used up. One of the characteristics of an expense. For example, fuel, your delivery vehicle, the fuel is going to be used up. That's a good example of an operating expense. There we are on the boat, and I've spent money on fuel to run the boat, but according to the business entity rule, that transaction I took in my own personal capacity. It won't get recorded on the books of the business. That is a personal expense. But any business expense is recorded in the books of the business. For example, the fuel used for the delivery vehicle, that will be recorded in the books of Calibre Education or your business. When the owner, myself, started Calibre Education, I put capital into the business, and every now and then I withdraw money from the business. Now these two accounts, capital records what the owner puts in, and what the owner takes out is recorded in the drawings account. These two owners' accounts are known as proprietary accounts. So just a little bit of terminology there, and there you can read the definition. But what the owner puts in gets recorded in the capital account, and what the owner takes out gets recorded in his or her drawings account in the books of the business. Remember, we're always looking at every single transaction from the eyes of the business. This here is an example of the capital account in the general ledger, and if I quickly interpret that, I put 20,000 Rand in on the 1st of February. It was deposited in the bank account, and I applied that rule. That's why the information was recorded on the credit side. And there I've just taken a screenshot of drawings, an increase in drawings. The rule says recorded on the debit side. On the 15th of February, took petty cash for 200, and on the 25th, more petty cash for 50 Rand. So there's an example there of the drawings account in the general ledger of Calibu Education. So proprietary accounts, the owner's accounts, capital, and drawings. Capital, what the owner puts in, and drawings, what the owner takes out. For the last part of this video, I'm going to compare the formal sector, the formal working sector, with the informal working sector. What I'm going to do is I'm going to look at the characteristics of each sector so you can understand the two sectors a little bit better. So I just went out and I took a picture of Builder's Warehouse, which is a big hardware store, a big group. It's a big business. Now, what would characterize how Builder's Warehouse needs to go about their business? There will need to be a formal bookkeeping system, and there we go, usually computerized, so there will be accounting software in order to record all the transactions of a business in the formal sector. You will need a qualified person to keep the records of the business, so an accountant. Transactions will need to be recorded on source documents. There's an invoice, and I think that's a check or petty cash voucher, but all the transactions will need to be documented when they take place by a source document. In the formal sector, the International Financial Reporting Standards sets the framework, so there will be principles to adhere to, accounting principles. Cash transactions are done through the business bank account, so a proper record is kept. Financial statements are prepared, so a statement of financial position, cash flow statement, a statement of profit and loss. Those statements are drawn up at the end of the year, and then there are control measures in place, so it's an organized workplace. Now, these are characteristics of the formal sector. So it's quite rigid and it needs to be well controlled, as the business is also big. It's big business. There need to be tight controls and things have to be done according to recognized framework. On the other hand, in the informal sector, certain characteristics can be found. The bookkeeping is customized to suit the needs of the owner. Records are done like we've been doing in these videos, manually. So they're not using computerized software. Remember, computerized software is expensive, accounting software. So bigger businesses will use them. Small businesses, normally not a lot of money involved. Most transactions are cash transactions, and quite often they're not documented. There's no need for a bank account. Financial statements are not required. Sometimes, or often, only one person is involved. It's easy to control, and the owner can plan on a daily basis. So once again, just up the road, I went and took a picture of an example of informal business taking place. There you can see a lot of cash changing hands. These people are selling fruit and vegetables and wood and chairs. This would be a typical example of an informal sector business type. So you can see that no proper records are most probably being kept. And that explosion, ladies and gentlemen, brings us to the end of today's lesson. I hope you enjoyed that video and you're branching out. I shouldn't say this, but carve your girlfriend's name on the tree trunk. I hope you enjoyed the lesson. Watch out for the crabs, and I will see you in the next video. Cheers.